after what were 2 hectic days of listening to Indian policymakers. So let me start there. You heard a bunch of ministers and chief economic advisor. What's the takeaway in terms of the India earnings story?
Sure. And thank you very much for having me on the program. It's been a fantastic 2 days here in Delhi. We've had 4 senior government ministers, the chief economic advisor to the government, 72 corporates, inclusive of 47 CEOs and CFOs. So it's given us a great degree of visibility in terms of the state of corporate India today. I would suggest that certainly I walk away more positive on 2 critical elements of the Indian story and therefore the earnings outlook moving forward. Number one, infrastructure, largely driven by productivity gains within that space. And then secondarily, growth of credit moving forward. On the infrastructure side, I'd give you 2 key examples. And so we heard the transport minister this morning discussing road build going from 2 kilometers a day to 20 kilometers on its way to 40 kilometers. The infrastructure deficit that India has faced is a key restraint to productivity in this country historically. That's clearly being dealt with by a very proactive government policy. I'd also indicate the productivity gains that we expect off the back of GST. We ran 7 tours around India, looking all over the country and visiting with corporate management teams in many different cities, and we heard lots of examples of real-world impact that the GST would have on people's businesses. I'll give you one specifically. We met with a tile manufacturer that has a factory in Rajasthan, and at the moment it takes them 3 days to drive from their factory in Rajasthan to deliver their tiles to Mumbai because of all the stops that they have to make along the way. Post-successful GST implementation, that will go from 3 days to only 12 hours. So significant productivity gains moving forward.
Okay, well, that's very heartening to hear if it actually pans out that way, and it looks like this time it's been cracked. But let me get to the other theme before I ask you your favorite themes here, consumption. You said that you've done 7 tours. We are sitting in a fairly successful monsoon season after 2 droughts. Could you see instances of consumption? Is that a theme you'll play?
It is, and we're overweight consumer discretionary. If I look at, you had mentioned the outlook for earnings before, if I look at earnings revision for India as a whole and then sector by sector, consumer discretionary has clearly been the bright spot. You've seen the overall earnings revision cycle for India as a market go from negative 14% in January to flat today, so very positive momentum. Within that, you've seen consumer discretionary revised earnings up by over 8%. So it's clearly a bright spot and is one of the key sector overweights that we have in the Indian market.
Okay. Well, you know, you guys, I mean, we had Adrian about 24 hours ago, and he was telling us that you are looking at a nifty target of 10,000 in the next 3 months, that is calendar 2016 probably.
Correct.
What might lead this rally? Which sectors, which stocks?
So we're clearly very overweight, a combination of financials, consumer discretionary, and cyclicals, and really believe that a movement into more positive economic growth will drive those sectors moving forward. One of the key pushbacks that Adrian gets to the call here in India is a valuation conversation. And the key critical thing that we'd highlight on that point is it's important to look at the right multiple at the right stage in the cycle. If we do believe we're at trough earnings and we're seeing a bottoming of earnings revisions, which we've very clearly seen in financial markets, then the right number to look at is looking at India on a price-to-book basis, where it does look relatively cheap. Looking at a price-to-earnings multiple at trough earnings can be very misleading and will actually force you to miss a rally.
Okay, in that case, which are the verticals you would, you know, bet on?
So I think probably the most interesting presentations I've seen over the last 2 days really concern the banking sector here. Obviously, there have been significant structural issues, both due to historic government policy as well as to the economic slowdown that India has faced. We heard very clearly from the finance minister yesterday, the chief economic advisor to the government today, as well as 3 bank CEOs, that government policy is very clearly focused on unlocking credit creation within the financial sector. I'd then point you to the JP Morgan research. We published a detailed report earlier this week where we're calling a bottom to the NPL formation process. If I look at what that drives in other markets, it starts to drive a significant increase in credit provision into the real economy. And that is a significant positive driver that we're looking for out of the financial system moving forward. And as Adrian probably noted, financials are one of our key overweights in India.
Well, actually, I'm asking you all the interesting questions, and my co-anchor is itching to ask more. Sonia, fire away.
Well, thanks for that, Lata. James, hi, good afternoon. This is Sonia from the Mumbai studio. Since you've spoken a lot about the domestic market, let me shift the focus to global markets because, you know, India has been dancing to global tunes ever since the talk of the Fed rate hike has come through. But I wanted your view on the possibility of the emerging markets sell-off post the Fed rate hike. Do you think that's a high probability at this point in time? And do you think that we've now entered a prolonged phase of volatility at least until the first Fed move comes through?
So there are two great questions there. On the first, in terms of the impact of a Fed rate hike on emerging market performance, one of the very clear pushbacks that we've had from our client base regarding our overweight call on global emerging markets is exactly that. What we would argue is that if a rate hike is occurring because of firming global growth, that's a very positive precursor for emerging market outperformance. And if you look at prior rate hike cycles, that's exactly what you've seen. Now, we've gotten into this environment where we've seen zero rates for such a long period of time that that's embedded into our psyche. But historical evidence suggests something very, very different. We do expect an increase in volatility, and I think one of the oddities of markets over the course of the past 2 years have been absolutely record low levels of volatility. The S&P moves less than 1% up or down for a record number of days recently. And so I think you'll very clearly see a hike in volatility in markets. Jamie Dimon, our CEO, had mentioned in his presentation yesterday that he would like to get the rate hike over and done with for exactly the uncertainty that you're discussing.
Okay, so having said all of that, what do you see as the trajectory for two markets, for India and for China? I know when we spoke with Adrian Mowat, he did indicate to us that he expects more money to flow into China versus India over the next 6 months. But do you think that there is an argument for liquidity to continue into both markets, an equal amount of outperformance from both China and India over the next, say, 6 to 12 months?
So it's a great question. The relative call on a short-term basis, to be clear, for Chinese outperformance is largely driven by investor positioning. If I look at portfolio construction across emerging market portfolios today, the average emerging market portfolio manager is about 280 basis points overweight India. That's the largest overweight that we see in all of global emerging markets. The closest behind that 280 basis point statistic is only 80 basis points, which is the overweight that currently exists in Russia, as an example. The most underweight market that we're seeing at the moment is China. And so as performance starts to catch up, we do think we'll see more funds flow into China than India on a short-term basis. But to be clear, that's not a negative call on India. Our index target is 10,000. We do expect 15% absolute performance out of India over the next 6 to 12 months. And so it's by no means a negative statement on India. It's just cognizant of the fact that investors are already very positive on this market and very negative on the Chinese market.
Okay. Well, let me take the emerging market argument forward. Actually, year to date, Brazil and Russia have done extremely well because they're also commodity plays. Would you say that, you know, some money could move from these economies, or at least incremental funds could come more to India and China because they are beneficiaries of the commodities trend?
Again, another great question. I think the critical element is why Brazil and China specifically ran. In Brazil, you had a significant change in view in terms of political risk premia as we worked our way through the impeachment process. That catalyst is, however, now over. For Russia, you had a play on the rebound in oil prices, and now that's starting to break down as oil starts to flatline. And so you have very specific drivers, political and a specific commodity price driving each of those markets. If I look across Asia right now, it's important to recognize that fund flows into Asia have significantly lagged both Latin America and CEMEA, and so I would expect to see Asia outperform as funds start to equalize between those various geographies and the catalysts effectively exhaust in other regions of the world.
James, you know, funds like yours and, you know, other foreign funds have normally concentrated on the upper crust, the nifty companies. Would you now start going down the pecking order to probably the top 100 companies instead of the top 50?
It's been a phenomenon that we've seen very consistently across all Asian emerging markets on a year-to-date basis, and it's largely driven by the fact, two criteria. Number one, a large, significant portion of the overall fund flow have actually been into ETFs, which by definition are buying index-related stocks. As we start to see a transition of funds moving from passive to active funds, which we're starting to see in a very, very small way at the moment, so we'll see how that trend plays out moving forward, we would expect to see a broad broadening in participation over time. Secondarily, as people get more comfortable with the overall growth here in India and the large cap stocks get more expensive because of ETF inflows, a lot of fund managers will start to look at some of the small and mid cap space to try to pursue more attractive valuations.
Okay, so you will get perhaps more money incrementally coming into the mid-cap space.
I think the critical element to watch will be the incremental funds flow into active versus passive funds. So far, that has very clearly benefited the passive side, which has benefited the large cap index-related stocks. If you start to see a move into active, I think that this mid-cap space here could get very exciting.
Okay, well, we've heard about some of the positive things you have seen about the Indian space and the emerging market space. What would be the red flags at the back of your head?
So I think the key risks, which are not our base case, but I think the key risk would be, one, you get a significant change in terms of political will moving forward. One of the very clear messages we heard from all of the ministers as well as the chief economic advisor over the last 2 days is the professionalism that we've seen in terms of a lot of the policy implementation really across the board. If that starts to change for any particular reason, then I think we would have to take a very different view. The other thing that I would highlight, if we are incorrect that we're sitting on the cusp of a significant expansion of banking credit into the real economy, then that would force us to change our view in terms of overall growth.
Okay. Well, I can assure you on the political part, I mean, we've been watching our country for the last so many decades. The political risk clearly is off. We've never seen such stability probably in the last 3 decades. Yes, about the economic extrapolation of bank credit into the economy, we also are waiting for Godot, as it were, but maybe this time around it is going to come, especially if rate cuts and surplus liquidity push banks adequately. James Sullivan, it was a pleasure speaking with you. Thank you very much for joining us.
Thank you very much for having me.
Well, that's a very encouraging set of views that we've got from James, especially because he seems convinced by the way the ministers have spoken, especially the infrastructure-related sectors or the heads of the infrastructure-related sectors. Okay, Sonia, back to you. What are you seeing by way of technical action?
Well, you know, for the market itself, Lata, it's been so very volatile.